Hi everyone, welcome to lecture 10. We are going to be talking about exchange rates and interest rate parity. So for everything we've done so far, we've been thinking about trade and international economics in real terms. So by real, we mean the quantity of goods and services. So in the physical world, how much does a good cost in terms of another? But in the real world, and by that I don't mean physical, but I mean like where we are in reality, almost all economic transactions are going to be in nominal terms. So by nominal, we mean in terms of currencies. So everything costs a certain amount of dollars or euros or yen. And this brings us to one of the complexities of dealing with international economics. So when we have international transactions, they're often going to involve exchanging currencies for each other. So there are about 180 official currencies in the world today, and the relative price of these currencies is called the exchange rate. So dealing with these currencies, understanding them and how they're determined is going to be very important for understanding cross-border transactions. So let's just get some vocabulary and definitions out of the way. So the nominal exchange rate is going to be the price of one currency in terms of another. So this is like the relative price of two goods, but it's in terms of currencies. So we're comparing two goods or two different currencies and looking at the price of them in terms of the other. There are two ways to quote this that are called the direct or indirect exchange rate. But really, this is just, which currency are we quoting the price at? So the direct way, this is going to be like the US-centric way, or the dollar-centric way. So this is the amount of dollars per unit of foreign currency. So for example, the direct dollar to British pound exchange rate is 1.38 right now. So that means that there are $1.38 per British pound, or thinking about another way, that one British pound costs 1.38 US dollars. The indirect exchange rate is the amount of foreign currency per dollar. So looking at the same dollar to British pound exchange rate, if we're going to quote that in the indirect way, it would be 0.72. So this means that there are 0.72 British pounds per dollar, or that $1 costs 0.72 British pounds. So these are telling us the same information, but in different ways. And it's important to keep track of the way that we're quoting this just for consistency. And so we know what we're actually saying. So because the textbook uses direct exchange exchange rates, we're also going to be using direct exchange rates. But just remember that these are equivalent and they're telling us the same information. So when we have changes in exchange rates, we're going to call those appreciations and depreciations. When a currency becomes more valuable, we say that it appreciates. And when it becomes less valuable, we say that it depreciates. So depending on how we're quoting the exchange rates, an appreciation or depreciation can affect the exchange rate differently. So for example, when the dollar appreciates, when it gets stronger, the direct exchange rate actually falls. It means we have fewer dollars per unit of foreign currency. So if the dollar gets stronger against the British pound, that means it costs more British pounds to buy $1, or it means that there are fewer dollars per British pound. So the price of the dollar goes up, but that means a fall in the direct exchange rate. Conversely, if we were doing indirect exchange rates, if the dollar gets stronger, the indirect exchange rate goes up because we've got more units of foreign currency per dollar. But since we're using direct exchange rates, just remember that they have this sort of counterintuitive feature of when the dollar appreciates, the direct exchange rate falls. So up is down. So one reason exchange rate appreciations, depreciations are such a big deal in international economics and international finance is because unlike other price changes, they affect the prices of all goods being imported or exported from a country. So if the dollar appreciates, all dollar-denominated goods become more expensive. So just to give you an idea of how exchange rates affect relative prices of goods, let's look at an example. So exchange rates allow consumers to compare the relative prices of goods that are quoted in different currencies. So suppose we're thinking about two goods, American jeans and British sweaters. One pair of jeans costs $40 and one sweater costs 50 pounds. And so we need to compare, we want to get the relative price in real terms of American jeans and British sweaters, and we need to use the exchange rate to do that. So if the direct exchange rate is 1.25, that means that there's $1.25 per pound. The relative price of sweaters, or this is like the opportunity cost of sweaters, how many pairs of jeans do we give up, is going to be 1.39. So one British sweater costs us 1.39 pairs of American jeans. Now say the pound appreciates. So the direct exchange rate rises from 1.25 to 1.5. You get more dollars per pound now. Well, in this case, the relative price of sweaters also rises. We now, one sweater now costs us 1.67 pairs of jeans. And this is fairly intuitive. If the pound appreciates, that means that anything that is priced in pounds is now more expensive, and anything that is priced in dollars is now cheaper. And so sweaters become more expensive relative to jeans. And we can see, the same thing happens when we go from 1.5 to 1.75. Sweaters become more expensive still in terms of jeans. So at the same nominal prices, different exchange rates can lead to different relative prices. And another way of saying this is that currency appreciations and depreciations can affect countries' terms of trade. Remember that terms of trades, this is like the relative price of its exports versus its imports. So if a currency appreciates, the price of a country's exports rises and the price of their imports falls. So if the dollar gets stronger, American consumers will suddenly find that anything they're importing has actually gotten cheaper, right? A dollar will go further in the rest of the world. But for people that are buying American goods, they've gotten more expensive. So American exports have gotten pricier. And for a currency depreciation, it's going to be the opposite. The relative price of imports will rise. So if the dollar gets cheaper, importing anything will be more expensive. And the relative price of exports falls. So people who would like to buy American goods from somewhere else now are getting a better deal if the dollar is cheaper. So in general, exchange rates are going to be set in one of two ways. Fixed exchange rates don't fluctuate over time. They're fixed. So there's a certain rate and they're going to stay at that rate. So governments will set this exchange rate. So they'll pursue a fixed exchange rate policy. And there's two ways that they can do this. They could either limit currency transactions, so they can just set the price and they can have some sort of official exchange rate window or something like that. And that's the only place that you can make exchange rate transactions. Or they can do that. They can maintain the fixed exchange rate through open market operations. So the currency could be traded in the international exchange markets, but the central bank or some other arm of the government will intervene, maintaining the supply and demand of that currency in such a way that the exchange rate stays at their target. So typically a fixed exchange rate is implemented by pegging a currency to another currency or a basket of currencies. So you would say, the Saudi riyal is worth roughly $0.27. And I think that's roughly an actual quote that I just gave you. They maintain a peg with the US dollar. Some countries will do a basket of currencies. So they might take the euro, the dollar, the yen, and tie their currency to some weighted average of those. The benefit of a fixed exchange rate is that countries will have stability in import and export prices. For countries that are very highly trade dependent, this can be beneficial. So if a lot of their national income is coming from exports, having a steady and predictable income flow from exports that's not going to depend on movements in different currencies around the world could be beneficial for them. So a lot of oil exporting countries will maintain a fixed exchange rate because they depend on export revenue from oil exports. Countries that have very tourism dependent economies will be the same thing because tourism is a form of export. The cost of fixed exchange rate is that you can have big problems if the fixed rate diverges too much from the market rate. So, for example, if the central bank is intervening somehow to maintain the fixed rate, that can become very costly for them to do because the interventions they need to do could be very, very large, very drastic. They might need to print a lot of money. Or in some cases, they might not be able to because they might need to buy some of their currency in exchange for foreign currencies. And if they don't have enough foreign currency at hand, they might not be able to do that. With capital controls, you can run into a different set of problems in that people just might not be willing to make transactions at the official rate if it's too different from what the market rate would be. And you can run into these shortages or mismatches of currency supply and demand. So it can be hard for people to exchange their domestic currency for foreign currency or vice versa. Floating exchange rates are a much more laissez-faire approach. So these change over time as supply and demand for currencies change. So basically, the price of a currency is going to be set by the market. The con of this is that you're exposed to fluctuations in export and import prices. Although that's not necessarily a con. I mean, sometimes those changes in export and import prices are responding to fundamentals, and it's optimal for the prices of currencies to reflect that. And the other upside of this is that the market price of the currency is always in equilibrium. So you can't run into this currency mismatch problem where you have a supply or demand mismatch between the domestic and foreign currency. So with fixed exchange rates, this is a policy that some countries choose to implement, but it doesn't come for free. There's a cost to maintaining it in terms of other policies. So they do require intervention to maintain, and this can come in one of two forms. They can either restrict currency and exchanges or other international transactions through what are called capital controls. So you can have these very strict regulations on how money can come into and leave countries. Any sort of cross-border transaction is restricted, and that's how you maintain the exchange rate. Or if you don't have capital controls, then the central bank is going to have to buy or sell currencies on the market to maintain the fixed exchange rate. If the central bank has to actively maintain the currency peg by doing these open market operations, this effectively restrains monetary policy from responding to domestic conditions. So one of the main goals of monetary policy in most countries is to prevent recessions, to manage business cycles. So if you have a demand shortfall, the central bank will print money or lower interest rates or do something to get the economy back on track. But if the central bank has to decide how much it's going to change interest rates or print money or reduce the money supply based on international supply and demand for money, they're not going to be able to respond to domestic conditions because those two things are going to affect each other, right? Anytime the central bank does anything, it's going to affect both the domestic economy and the exchange market. And so this leads to what's called the international finance trilemma. So basically, we have these three policies, and countries can have, at most, two of them. So you can have no capital controls or free capital mobility. And if you have no capital controls and you have a fixed exchange rate, then you can't have monetary autonomy. You can't have an independent monetary policy. So that would be over here on this side A. If you're in C, you can have a fixed exchange rate and monetary autonomy or independent monetary policy, but the cost of that is you have to impose capital controls. So you can't have free capital mobility. Or if you're on this side of the triangle, you can have no capital controls and an independent monetary policy, but in that case, you can't maintain a fixed exchange rate. So you have to have a floating exchange rate. So for countries that do wish to pursue a fixed exchange rate, they have to give up either free capital mobility or monetary autonomy, and there's really no way around that. For floating exchange rates, we don't face that same policy trade-off, but we do need to think about the price of these currencies or the exchange rate because they're going to be an equilibrium outcome. So floating exchange rates are going to be set in the foreign exchange market. So just to describe this market briefly, banks, corporations, central banks, and other financial institutions are going to buy and sell currencies as part of their day-to-day operations. And there are many reasons for this. They may want to invest in foreign assets. They may simply want to exchange assets in order to make international transactions. They need to change their dollars to euros or yen or whatever, just so they can transact with companies or other institutions in those places. Or central banks in particular are always buying and selling currencies. That's kind of their game. And that's going to influence the foreign exchange market. So exchange rate transactions or exchange rates themselves are going to fall into two types. We have spot exchange rates, and that's going to be the current exchange rate at like this moment in time. So parties will agree on an exchange rate and trade at that rate immediately. Or we have forward exchange rates. So for forward exchange rates, parties will specify an exchange rate for a future transaction. So say 30 days from now or 100 days from now, and they'll agree to make a trade at that rate in the future at whatever period they specify. So for looking at the equilibrium exchange rates, we're going to take an asset-based approach that's going to account for both the spot and forward rates. So first, let's define financial assets. Financial assets come in many forms, stocks, bonds, cash, and just a simple taxonomy of financial assets, we could say that they have different risk and return profiles. So return is the expected gain from holding the asset. So for example, if you hold a stock and you expect it to grow by 10% over the next year, that would be the stock's return. A bond or a different stock or cash would have a different return profile. Risk is the variance or uncertainty of that return. So for example, a bond gives you a guaranteed stream of payments. A bond is just a contract that says, I'll give you this much at this date and this much at this date and so on and so forth. But it's guaranteed, it's fixed. The price of a stock, so the returns for a stock depends on the price of that stock whenever you sell it, and that fluctuates all the time. So 1 year from now, it could be 10% higher or lower. And even though you have an expected return for a stock or a portfolio of stocks, it's not guaranteed, so it's riskier than holding a bond. So for a liquid financial market, a principle that we're generally going to follow is that the equilibrium prices of assets with the same level of risk is going to set the expected return of those assets to be the same. And we're going to apply this approach to the equilibrium prices of currencies. So the exact condition that we're going to use is what's called interest parity. So in general, exchange rates are going to set equal the expected real return of similar assets that are denominated in different currencies. So the intuition here is that in financial markets, actors really only care about the expected real return. If there's any difference in return between similar assets, then it will be arbitraged away until it's no longer there. So arbitrage is what we call a risk-free trade. So the classic example of this, or the typical example of this, is when you have two assets that are basically equivalent, So, they have the same return, they have the same risk, but their prices are different. And if you have that, there's a risk-free trade, right? You can sell the asset that has a higher price and buy the asset that has a lower price. And you're holding the same thing at the end of the day, but you've made money off of that transaction. So if we see these differences in expected real return of similar assets, they're going to be arbitraged away and prices are going to adjust until that real return is the same. And so the condition we're going to use is called interest parity. And so interest parity holds when the expected return on deposits of currencies are equal. And when that's true, exchange rates are going to be in equilibrium. So deposits of currencies, we're thinking about deposits in a bank account, or what is basically equivalent is just holding government bonds. So if you put money in a bank account or you buy a government bond, this is basically a risk-free investment. You have some guaranteed return over a certain period, and banks occasionally default, but it's pretty rare. Governments also occasionally default, but it's pretty rare. And so over short time horizons, or if we're restricting to places where default is unlikely, this is effectively risk-free, and we have a guaranteed nominal return. In addition, bank deposits are essentially currency. They're highly liquid. You can always take them out and trade them. And government bonds are also highly liquid. In fact, government bonds are often used as substitutes for currencies, so you can transact in them directly. So these are highly liquid markets where we expect equilibrium to be reached. So one wrinkle here that's going to be different from normal financial asset pricing is that with foreign currencies, we need to make exchange rate transactions not only to purchase the assets, but to sell them. That's what we mean by the expected real return. So if we're going to hold a foreign asset, we need to convert our dollars to that foreign currency to buy the asset. But then at the end of the period where we're holding it, we need to convert our returns back into dollars. And so we need to account for both the spot rate and the expected future rate. And so the expectations of future exchange rates are going to be an important determinant of current exchange rates. Okay, so let's go through this in a little more detail. So we're going to have two currencies, the US dollar and the Japanese yen, and two assets, a one-year US Treasury bond that's denominated in dollars, and a one-year Japanese Treasury bond that's denominated in yen. So we're going to say that the interest rate for the US bond is RUS, and the interest rate for the Japanese bond is RJP. So if you buy a US bond, the expected real return from holding that bond is RUS. So if you buy $100 worth of this bond, at the end of the period, you will get your $100 back plus RUS. So if this was 0.05, we would get $5 back, in addition to the 100 that we put in. And for a US-based financial actor, there's no exchange transactions, so the real rate of return is simply the interest rate. We put in $100 now, we get $105 back in the future. If we're considering the real return on a Japanese bond, we have to account for both the current and future exchange transactions. Okay, so the nominal return on the Japanese bond is RJP, but we first must exchange dollars for yen, hold the bond for a year, then exchange back to dollars at the future exchange rate. Since we're holding that yen-denominated asset for a year, the difference between the spot rate and the future rate also enters into the expected real return of the yen-denominated asset. So for the spot rate, we're going to call that E USD to JPY, and the future rate is EE to USD to JPY. Or I'll just call this the spot rate and the future rate for clarity. So if the yen is expected to appreciate against the dollar, that's going to increase the expected real return of the Japanese bond. And if the yen is expected to depreciate against the US dollar, that's going to decrease the return. So over here, if we're looking at the total return, the total expected real return of holding this Japanese bond, we have the nominal interest rate. So what we're paid in yen just for holding that bond for a year. But then we also have the expected appreciation of the yen. So this is, in percentage terms, the difference between the future rate and the spot rate. So it's the future rate minus the spot rate divided by the spot rate. And this tells us the expected percentage difference between the yen tomorrow and the yen today. So if expected rate is greater than the spot rate, this will be positive. And that'll increase the expected real return. But if we expect the yen to fall in the future, this will be negative. So interest rate parity will hold when the expected real return of these two assets is equal. So on the left-hand side, we have the nominal US interest rate. On the right-hand side, we have the nominal Japanese interest rate plus expected appreciation of the yen relative to the dollar. So in other words, given interest rates, so if we know RUS and RJP, and fixed expectations about future exchange rate, so the expected rate, EE, we can solve for the spot rate. Or if we know interest rates and the current spot rate, we can solve for the implied expected future exchange rate. So these are sort of two different economic problems. One is, we know interest rates and fixed expectations. What's the equilibrium exchange rate going to be? So if we have, actors and we know their expectations and we know the environment, the interest rates, we know what the equilibrium is going to be. But in the real world, the things that we can generally observe are interest rates. These are published daily or hourly or something on all sorts of places like Bloomberg.com. And we know the spot exchange rates, but we rarely know expectations. So expectations are just something that people have in their mind. Some assets will reflect these. So there's yen futures or euro futures or something like that. But if we observe interest rates in the current spot rate, interest rate parity implies a certain expected future exchange rate. So that's a different economic problem. Okay, so let's go through an example of this. Suppose that the return on a US one-year bond is 2% and the return on a Japanese one-year bond is 1%. So remember, interest rate parity says that the real return between these two assets should be the same in equilibrium. So if the US return is 2%, the Japanese return is 1% in nominal terms, and for the expected real return to be equal, the yen must have an expected appreciation of 1%, because that would make up the difference. So we can start with our condition here. On the left-hand side, we have the dollar interest rate. On the right-hand side, we have the yen interest rate plus expected appreciation of the yen. And this says that if we just set these two things equal to each other, and then we subtract 0.01 from both sides, that the expected appreciation of the yen should be 1%. So we expect the yen to be 1% more valuable 1 year from now. So say 1 year from now, the expected future rate is going to be 100 yen per dollar. Or in other words, EE, and this is the direct exchange rate, this is going to be 1/100. So there is 1/100th of a dollar per yen. So if we plug this in, the interest rate parity condition, we can then solve for the spot rate currently. So we have 0.01 equals 0.01 minus E over E. So this is expected appreciation of the yen here. And this is the spot rate. So now let's multiply both sides by E and then subtract E from both sides. Then if we solve for E, so we divide both sides by 1.01, we see that the current direct exchange rate is going to be 0.009. So the future exchange rate is 1/100, or there's 0.01 dollars per yen, and the equilibrium spot rate today is 0.009 dollars per yen. So in that case, the yen is expected to appreciate by 1% over the next year, and that's going to set the expected real return of the dollar and yen assets equal to each other. So we can also represent interest rate parity graphically, which is going to be helpful for building out some intuition. So on the y-axis here, we have the equilibrium exchange rate. And on the x-axis, we have the rates of return of the two assets. So this vertical line here, this is just going to be the nominal interest rate on the dollar asset. So this is just a straight line. It's just a fixed interest rate. And it can move up or down. And this downward shifting line, or downward sloping line, this is going to be the return on a euro asset given the interest rate and expected future exchange rate. So this is going to tell us, given the nominal rate and expected future rate, what's the expected return on this euro asset at different levels of the current spot rate. And where these two lines intersect, the return on these assets will be the same, and that's going to give us interest rate parity. So that's going to tell us equilibrium in the spot exchange market. So let's look at what happens graphically when the dollar interest rate rises. So the dollar interest rate rises from R1 to R2. And interest rate parity says that the expected return on euro assets must also rise in order to maintain equilibrium. So the return of holding a dollar asset is increased, and we need the return of a euro asset to increase as well, maintain interest rate parity. So if we assume that the euro interest rate is fixed and the expected future exchange rate is also fixed, then the spot rate is going to have to change. In order to increase the expected return on holding that euro asset. And so at the new equilibrium point, we can see that the spot exchange rate falls, or in other words, the euro depreciates, or the dollar appreciates, until the expected return is equal. So if the euro depreciates, but we've kept the expected future exchange rate fixed, that means that the difference between the future rate and the current rate, exchange rate of the euro, has risen. So exchange rate appreciation, or the expected appreciation of the euro, has risen, and that's what increases to increase the return on euro assets. So this is fairly intuitive. So the dollar interest rate rose. This makes dollars more valuable to hold, and so the dollar appreciates against the euro. So what happens when we have a change in foreign interest rates? So in that case, the expected euro return curve is going to shift out. So the interest rate has increased, but we're fixing the expected future rate of the euro. And since the dollar rate of return has stayed the same, expected appreciation of the euro has to fall to maintain interest rate parity. So we can see in the new equilibrium, the exchange rate rises, or in other words, the euro depreciates against the dollar. The euro appreciates against the dollar. Since the expected future rate is fixed, this is going to reduce the expected appreciation of holding euros. So the intuition here is pretty similar. The euro exchange rate increased, or the euro interest rate increased. This made holding euros more valuable. And so the price of euros relative to dollars also increases. We would also see a similar effect if the expected future exchange rate rose. So if we expect the euro to become more valuable 1 year from now, this increases the real rate of return on holding a euro asset. In order to reduce it back to equilibrium, the euro would rise today to reduce expected appreciation. So to summarize, exchange rates are very important in international economics and international finance because they determine relative prices of most all international transactions. Some countries maintain fixed exchange rates, which insulate them from changes in export and import prices, but these do come at a cost. Floating exchange rates, on the other hand, are set by supply and demand in the foreign exchange market. So these are equilibrium prices, and the foreign exchange market is in equilibrium when the interest rate parity condition is met. This holds when the expected real return of deposits in different currencies is equal.